The second thing also is that the International Accounting Standard Board has also issued some amendments to existing accounting standards that we need to be mindful of. The first one that we must know about is an amendment to the disclosure requirements in respect of accounting policies in IAS 1, presentation of financial statements. Now, the amendment is just a very simple thing that companies are required to now disclose their material accounting policy information instead of significant accounting policies. Now, prior to this amendment, the requirement was that companies are supposed to disclose accounting policies based on their significance. So significant accounting policies that they are using in the preparation of the financial statement should be disclosed. Now, it is not about how significant the accounting policy is, but it should rather be based on the materiality of the accounting policy. The idea is to reduce the volume of disclosure and to all just provide disclosure for things based on their materiality. So it's going to reduce the number of paragraphs that companies will write in respect of disclosure when it comes to accounting policies, but they are supposed to now just provide things that are really material to the financial statement to the users so they can understand and make significant decisions. So that is the first thing we must understand. This actually became effective in January 2023. But it is something that you need to understand going into the future in 2024. The next thing is the amendment to the definition of accounting estimate as enshrined in IAS 8, accounting policies, changes in accounting estimates and errors. Now, current definition for accounting estimate is that an accounting estimate is an approximation of the amount of a business transaction for which there is no precise means of measurement. Now, this definition is a little bit not clear. So the International Accounting Standard Board has issued an amendment to give a definition to what accounting estimate is. And so the new definition for accounting estimate as per this amendment is that accounting estimates are monetary amounts in financial statements that are subject to measurement uncertainty. Monetary amounts in financial statements that are subject to measurement uncertainty. So that is the new definition for accounting estimate. Now, it is important to also know that the board clarifies that a change in accounting estimate that results from new information or new development is not the correction of an error. So that is also another thing. Now, this also became effective in January 2023, but going into 2024, it is something that you must know about. So if someone should ask you, what is accounting estimate? Your definition is that monetary amounts in the financial statements that are subject to monetary uncertainty. So that is the second thing that you need to understand. The third issue about the amendment is also an amendment made to IAS 12, income tax, in respect of how deferred tax is calculated and recognized on certain items. For instance, the introduction of IFRS 16, which is leases, brought in the way we are supposed to account for leases, which is contrary to the way we saw leases in IAS 17, the previous accounting standard. But then what is the deferred tax implication of leases and deferred tax implication for decommissioning cost or provision for decommissioning cost? And so there is a new amendment on how we are supposed to account for these things in the financial statement of the entity. And we will discuss this also later on when we are doing the IFRS masterclass. Again, this also became effective in January 2023, but going into 2024, it is something that we need to really be on the lookout for. How we calculate deferred tax assets and liabilities on lease obligations and lease assets, and the way we calculate the deferred tax assets or liabilities in respect of decommissioning cost. Now, in addition to these two things, there is also an amendment by the OECD in respect of what we call the International Tax Reform Pillar 2 Model Rules. Now, you see, this is what happens generally. There are many countries, in order to attract foreign direct investment, to increase their GDP, create employment and growth, they provide tax incentives or tax benefits to various investors. What it means is that these multinational companies will come into, especially these developing countries and even some developed countries, and they are going to be given favorable tax breaks. So the new law here is that where multinational companies whose revenue is at least 750 million euros is preparing their financial statement, there is what is then called the top-up tax. In other words, the minimum tax to enhance international tax compliance and growth and equality, the minimum tax that every company is supposed to pay in whichever jurisdiction they are in should be 15%. So anytime they are paying a tax, maybe they have a subsidiary that is paying a tax in a certain jurisdiction below 15%, there has to be a top-up tax that the parent company must pay. So that is the rule about the international tax reform Pillar 2 model. It is a way to ensure that countries don't get a lot of investment at the expense of other countries. Because if, let's say, Ghana say that, oh, okay, any company coming to operate in Ghana, whatever income you earn, you're going to pay 10% as tax. A lot of companies would want to come because in their country of origin, probably they are paying 25%, maybe they are paying 30%. So then they would troop in and come and do a lot of investment in Ghana, thereby preventing their home country from growing, from expanding, from getting a higher GDP and bringing about economic development in their individual countries. So to prevent this, there's a benchmark of 15%. Anything below 15%, then there has to be a top-up that a parent company must pay. And we will get into some of these things also later on during our IFRS masterclass discussion. Now, technically, this does not change the way we do calculation for taxes, deferred tax, asset, deferred tax liabilities and issues, but we'll get into this later on during our IFRS masterclass. But it is something worth noting going into 2024.